Coming up, US inflation rises more than expected. What does it mean for global interest rates? And the Australian share market falls as a result. All of that next. It is Thursday, the 11th of April, 2024. This is your daily 10-minute business and finance news wrap. The Australian share market did fall today. The S&P ASX 200 down 0.44% to 7,813. That's as US inflation rose more than expected to 3.5% in March, up from about 3.2%. For more details, I spoke with Damien Boey, the Chief Macro Strategist at Barrenjoey. So, Damien, US inflation came in stronger than expected at 3.5% annually. Higher costs for fuel, housing, dining and clothing drove the increase. What does this say about the US economy and the implications for the timing of US interest rate cuts?
Yeah, that's a great question. So there was a camp that was basically saying, look, inflation at the start of the year has surprised to the upside, but maybe it's just seasonal. And so you get to the March data when a lot of that seasonality should have disappeared and it comes in strong. And if you exclude all the volatile items and all the so-called imputed or made-up items within that basket, well, actually the inflation print was very strong at 0.7% month on month. So this is clearly showing some signs of potential reacceleration in inflation. And I think what it does is it will push out those Fed rate cuts. So there are some people who think that the Fed will still cut simply because they've said that they will, but this makes it very hard. Certainly no cuts before June. And then the closer you get to the US election, obviously it gets a little bit more tricky to adjust interest rates around that time. So if you don't really adjust rates by September, you're kind of not doing it at all for this year.
What does it mean for Australian interest rate cuts? I mean, some are suggesting we may see it around November. I've seen some commentary now saying, hey, it'll be pushed back now to 2025. And does the RBA really follow the US? I mean, don't interest rates hit the Australian consumer faster and harder than those around the world because so many people in Australia that have a mortgage are on variable rates?
Yes. So if you speak to our economists, Joe Masters and John McMenamin, or if you speak to our interest rate strategist, Andrew Lilly, that's certainly the view that we have as a house. So because of the fact that, transmission of monetary policy is a lot faster in Australia compared to the US, that can explain why Aussie yields are somewhat low relative to US at the moment. And we have a view, our economists have the view that it's a November rate cut. They pushed that from August to November. Our rate strategist, Andrew Lilly, doesn't really think that there will be a cut this year, but he does think that ultimately there will be an easing. So you can kind of see the direction here that all of this data, to the extent that it's global, is sort of making us nervous about the proposition of cuts and maybe pushing them to next year. But in Australia, most people still think the disinflation story is intact. Now, I guess the issue is how much should the RBA be following the Fed? And if you're looking at what RBA officials are saying, they have a whole lot of things that they worry about that are largely domestic, maybe China. And, the Fed is one of many considerations, but not particularly high up the priority list. Having said that, if you look at the ECB or any of these central banks around the world, they pretty clearly say that, look, we're waiting for guidance from the Fed before going. Back to your original question, one of the things which is very badly misunderstood at the moment has got to do with exactly how do we come up with our inflation forecasts. So most people will say, let's just look at wages, let's look at productivity, let's look at costs. And if cost inflation is coming off, therefore inflation is coming off. But one of the things that you've heard during reporting season, and one of the things which is becoming quite prevalent now, I think, in the US, is actually the profit margin, the pricing power on top of costs. And I think what's happening here is that pricing power is surprising well and truly to the upside here and abroad. And this is a bit of an issue. It's not really normal for this stage of the cycle. So to the extent that there is some confusion about this dynamic, then potentially there is a bit of a global read-through. So my view is that all of what's happening reinforces the idea that we should really call our jets on rate cuts. And it's rational for the market to be pricing them out for this year to some degree.
Okay, so can you run us through how the markets have reacted to this latest development, both equities and currencies?
Yes. Yeah, so currency's been a bit of a mixed bag. So usually what you find, or theoretically what you find, is that if one country's got higher inflation than the other, it should be devaluing. But because markets are quite short term at the moment, the upside surprise in US inflation is driving up US interest rate pricing, and that's been positive for the US dollar, which means that the Aussie dollar's taken a bit of a hit. Now, what you're finding in the Australian equity market is that even though US equities are down roughly 1%, our equity market's not down anywhere near as much, because you can think of the Aussie dollar falling as a bit of a shock absorber. So in US dollar terms, we're kind of down in a comparable sense. Now, for our equity market, although it's down, what you're starting to see are that the resources companies and the insurance companies are starting to find some legs, whereas anything which is a little bit more interest rate sensitive from a valuation perspective or from an earnings perspective, they're really lagging, like banks, some of the growth stocks, some of the real estate stocks. So that's kind of how we're seeing this at the moment. I guess the big question is really how much of an inflationary signal do we have here? So you have US yields going up. You have inflation expectations for consumers and for the bond market investor going up. You have the gold price going up. You have oil prices going up. At some point, this sort of inflationary dynamic gets a bit of a leg of its own. So this is something that I think we need to be very careful of, and policymakers need to be careful of, because expectations matter.
So, given what seems to be then this changing dynamic, this theme that interest rates may be cut later than expected, is it changing the way you're viewing investment opportunities at the moment?
Yeah, so we've had the view for a while that you want to kind of be a value investor. You want to be exposed to things that benefit from higher interest rates. You want to have some resources exposure to the extent that there's some inflation risk out there. So all of this doesn't really change dramatically our point of view. I guess the way we were looking at things had a little bit of an interruption late last year when the Fed pivoted, but this is getting things back on track. I feel that we're kind of doing a bit of a rewind back to the fourth quarter last year, just before the Fed pivoted, and just as interest rates in the US were starting to push towards 5%. It's a bit of a hail back to those times. The only difference being that the way the gold price is behaving between then and now has actually changed quite a bit. So my view is that this sort of portfolio where we're looking for inflation hedges in insurance, with say some of the industrial companies, the pricing power, like say a Brambles or an Horizon, looking at a company like Telstra, which also has pricing power, and also some of the resources companies, I think that's appropriate for now. When will things change for us is really when you get to a point where interest rates are sufficiently high or oil prices are sufficiently high that they're actually really hurting the economy. But I don't think we're quite at that point yet.
That is Damien Boey there from Barrenjoey. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial